new controls go in, or with some of our other customers, it may just be the economy's booming, their orders are way up, or heaven forbid we hit a deep recession, all of a sudden they're way down. So I've never been big on hedging 4 to 5 years. What we always have been big on is controlling basis, because in the last 2 decades, the real volatile part of the supply chain for natural gas is the basis, or the delivery cost. Josh, you want to start? We'll start going through some slides. So just to recap, this is similar to the slide that I sent out about a week ago. This is the 2018-19 winter strip, which is the 5-month strip: November, December, January, February, March. And this is the composite. Now, I know we say this in the weeklies all the time. I'm not sure everyone reads all the way through the weeklies. But when you talk about strip pricing, you're talking about buying equal volumes in each month of that strip. So every month, say, you're buying 1,000 decatherms. Well, that's what the strip price represents. What we do is we actually have a feed into our spreadsheets that bring in the NYMEX and apply it against your particular volumes. So if you have 1,000 decatherms in December, and then you have 2,000 decatherms in January and February, that's going to obviously skew the strip price. So it's always good if you actually want to know. Like on here, you'll see, last week it actually hit down around 286. And for those of you that hedged, you didn't get 286. And the reason for that is the volume weighting of when you actually burn the gas. On these charts, by the way, just one little tidbit. If you're able to, if the resolution is good enough, you can see each one of these bars has a tip on the left and a tip on the right. The tip on the left represents where gas pricing started on that particular day, and the tip on the right of the bar tells you where gas pricing was at the end of the day. So, if you want to see how, just looking at the chart, you want to determine whether it was up or down for the day. If the tip on the left is higher, then the contract was down that day. If the tip on the right is higher, it's up that day. So just a little tidbit on reading the chart. There are 4 different areas I'm going to try to quickly talk about this morning. One is soaring natural gas production. Second is the historically low natural gas inventories. The third is what we're seeing in terms of weather for this winter. And then the fourth is one we've never had before, which I'm calling the wild card on the Potomac. And you can probably guess what we're going to talk about. All right, first off, let's talk about soaring natural gas production. As you can see from the charts, gas production has been just flat climbing. This chart, I like this chart because it talks about 3 different types of gas production, which when you read news articles, people sometimes get confused. Gross withdrawals is everything that comes out of the fields. Now, what happens though, especially in the Bakken, which is in the Dakotas, is they flare a lot of that, so it never actually gets to market. Then you have marketed production. That's actually the gas that is gathered up and put into the U.S. pipeline system. And then you have dry gas production. And once again, we can use the Bakken as an example. The Bakken is actually a oil-rich production area. So when the gas comes out of the ground, it's coming out with oil content. And they have to then strip a lot of that liquid ethane out of there to turn it into what is known as dry gas. You can't put liquids into a underground gas pipeline, or it causes a lot of issues with corrosion. So there's very tight quality standards. And you'll see, if you went back and you looked, like when big production started coming out of the Marcellus in Pennsylvania and Ohio, they had issues because they hadn't built the infrastructure yet. In time, they had to build what they called stripping plants that actually take those liquids out of the gas stream and bring it down to be dry gas. One interesting little story there is we actually had a power plant on TVA that the BTU content, because of liquids in the gas, got so high that it tripped the power plant. So we really had to get on the pipelines about enforcing those dry gas standards. Next.
That's my
Yeah, that's you.
There we go.
Wake up, Josh. Come on.
There we go.
The Energy Information Agency comes out with weekly and monthly reports. This is a quote out of their most recent, just to talk about the chart I just showed you was through 2017. EIA is mentioning how much production is up this year to 82.2 BCF, and then how much they expect it to be up next year, 84.7 BCF. So as we can see, based on current circumstance, they're expecting continued strong growth in natural gas production. However, and this is where I have a bit of an issue with the narrative this year, because the narrative has all been about soaring natural gas production. In fact, I got on one of my buddies who's a financial trader last week because he put out a news article talking about soaring natural gas production, and that's how I ended up using the word soaring in this case. The issue is that yes, gas production is way up, but if you go look at the data, so is demand. In fact, if you look at January of this year, we actually exceeded the amount of gas that was consumed during the polar vortex year by over 100 BCF or 3 BCF a day. And even if you look at the summer, year on year, demand in the commercial industrial sector is up by 150 BCF or 5 BCF a day. So a lot of people in the market are talking about soaring production, but they're not tying it all together, because we actually have soaring demand at this point too. And that comes from a number of things. Cheap natural gas. At one point in my career, for instance, fertilizer consumed a great deal of natural gas in this country. But then when prices got crazy in the early 2000s, a lot of that fertilizer production moved offshore. But with the advent of shale gas, those fertilizer companies have come back and built new facilities. And consequently, you're seeing fertilizers picking up. You're seeing chemicals like Monsanto or 3M that use natural gas as a base gas to produce synthetic fabrics. They are cranking up and building new facilities. And if you read my weeklies, of course, I'm always very tied into the power industry. And power industry is, as they build natural gas plants, it's kind of interesting to listen to Washington, though, because they're trying to reprice or rig the market to run coal. But what they don't understand is that once a utility turns off the coal plant, they ain't turning it back on again. The O&M to just maintain a plant in operational condition is just tremendous. That is one reason why TVA, when it looked at 1950s era coal plants, and then it looked at investing in new natural gas facilities, not only did you have 1/10 of the staff, but you immediately dropped the O&M by just several factors. Okay, Josh tells me I'm talking too much already. In addition to industry, electricity, power generators, we're also exporting. I'm sure a lot of you may have heard in the last year that we've become net exporters of energy. Well, that's true on natural gas side. Here you can see exports by pipeline, and exports by pipeline go both north and south. Usually we net import from Canada. We used to get a lot of gas from the Western Canada coal basins, shells out there too. But we also send gas back to them, especially along the east coast. Yeah, now I'm starting to get tangled up here, Josh. East Coast, in the Quebec, Montreal, and those areas in the East Coast traditionally pick gas back up from the U.S. coming across the pipelines at Niagara. And then the big news, obviously, has been the expansion of the liquefied natural gas industry. The first one of those came on about a year and a half ago, and that was Cheniere down in Sabine Pass. And those guys were actually smart. I was actually at that facility back in 2010 when it was supposed to be an import facility. But they had the great idea to design the facility so that it could be turned to be an import facility. So they actually were the first ones to come online. Now, what's interesting right now is The exports most recently in June exceeded 3 BCF. They were up around 3.3 BCF of LNG leaving the U.S. shores. But we also have Sabine Pass Train 5 and Corpus Christi Train 1 that are already starting to test in the fourth quarter this year, which should be in full operation in first quarter, January, February, right when we don't need them, of 2019. And that'll represent about another BCF to 1.2 BCF of gas going offshore. So we've got, here we're making the point, you've got soaring production. Okay, go with it. But people need to talk about, we've also got soaring demand. And what that equates to is historically low natural gas inventories. As I was talking to Josh here earlier, if we have soaring production, it should be showing up in the natural gas inventories. Natural gas inventories should be virtually overflowing. But the fact that they're trailing last year tells you that the supply-demand scenario is right now at the moment favoring demand.
As you see here, pretty good.
Yeah. And I'm sure this chart goes out with the weeklies, and you can see how far under we are. Right now, depending on which source you read, we haven't been this low at this time of year since 2001 or 2003. And quite frankly, if you go back 15 years, we didn't even have the storage fields that we have today. Quite a few storage fields have been built in the last 15 years. So it's really not a fair comparison. Even if you say the absolute number was lower at some point in 2001, it's just not a reasonable comparison. We are historically low on inventories. There's just no doubt about it, and there's no way to catch up. In fact, the storage report that came out today lost ground against last year again to the tune of about 25 BCF. So we're not making it up, and we're going to end winter. The best case scenario, EIA says 3.3 BCF, which is way under the 3.3 TCF, trillion cubic feet, which is way under the 4 trillion cubic feet we just had it twice in the last couple of years. So we are going to be historically low. Now, a lot of people don't understand what historically low inventories are going to mean. First off, they're going to reduce deliverability for the utilities, which is actually a big deal we're going to get into. And then what happens is, since storage is close to the markets, and that storage isn't full, it means that the markets are going to have to depend more on gas coming from the more distant production fields. And a lot of these pipelines built in the 30s and 40s, I mean, they try to maintain them, but they're more subject to having outages. And that's where you get your really big peaks in price, what we sometimes refer to as the black swans. If you go. So this is kind of a generalized chart, but if you think about it, and I use the analogy a couple of times, that you can compare gas storage with a balloon. You blow up the balloon at the kids' party, you blow it all the way up, and that thing is just going to take off and fly around the room. But if you only fill that balloon up halfway, you're not going to get the same result. And that's the issue we're looking at right now. If you look at this chart on the left, you're talking about the gas rate, or the flow you can expect out of a storage field when that storage field is fully filled. And what we're seeing this year is that, and Josh just got back from Chicago, they're saying the fields in Michigan are going to be at 80%. And consequently, what happens is that means that there's less gas coming out of the ground to support the utilities in that area. And once again, as I just mentioned, that means that they're going to have to be in the market and fighting for that natural gas is going to be coming all the way up from the production areas. And consequently, there's another, when I worked at Northern Illinois Gas, they looked at January 21st as being the penultimate winter day. And when I say that, what they meant was that prior to January 21st, they would husband their storage because they wanted to maintain that deliverability, because they have to be able to meet an extremely cold peak day. But if they were full and they had cold weather early on, they would still pull, but they would husband it to make sure that they kept a great deal of the pressure in place in the storage fields. This year, though, they're not going to be able to do that. And Josh, talking to some of the utilities in Chicago, they told him as much. And what that also means, and we talk about pricing, last year, the gas markets can do wild things, and we've seen it before. I mean, extremely cold weather, and the market's going down 20 cents, and you're all sitting there. That's commodity markets, because you've got a lot of speculators in the commodity markets. You've got a lot of technical traders in the commodity markets, and they're doing things for reasons that aren't necessarily linked to fundamentals. But what is going to happen this year is that with the utilities not able to pull on their storage early, if there's cold weather, they're going to have to be in the market actually buying. So where traditionally the utilities may not be in the market much in November, December, they are going to have to be in the market November, December this year to make sure that they don't use up what is an already depleted storage. And, I know a lot of you, talking about infrastructure again, all these dots on here are storage fields. And you can see all those storage fields in Michigan, in Illinois, Ohio, Pennsylvania. Those are the storage fields that are close to the cities that allow the utilities to bulk up on peak winter days. And, when they're not full, next slide, the gas is going to have to come from the more distant production fields. And once again, as I mentioned earlier, when you're transmitting natural gas through a 2,000-mile pipeline, they try to maintain them, but there's a much higher risk this winter that things are going to happen. Why don't we take a break just for a minute, Josh, and let people, I don't want to get too far away from folks that may have questions.
So if you have questions, again, you could do a couple things. One, write them down, send them through the text chain on the left, or email. We can kind of pull them together here, and maybe when this is done, Blake, we could jump into it from there. So
okay.
So yeah, a few more slides to go here, kind of more weather-based stuff, and then go from there. So I'd say keep rolling.
Okay, I'll keep rolling. Yeah, this is the latest out of the Climate Prediction Center, and they're calling for El Nino. And they're saying that the chances right now, they're projecting that the probability of El Nino will increase as we go into the winter. And you might as well go ahead on the next slide. Of course, El Nino. We had a monster El Nino in 2015 and had one of the warmest winters we've had. Once again, they're forecasting, if you look, upper Wisconsin is supposed to be much above normal. And in all of Wisconsin is above normal. In fact, most of the heating load states are above normal, according to this, for the coming winter. So, when you look at supply demand, you look at, we have historically low inventories, we have roughly balanced supply and demand, but you're heading into a warm winter. So that's kind of the wild card. I mean, if we get 5 degrees above normal in January, like we were a few years ago, this market may not have an issue with price this winter. But if we get, even in a warm winter, you can get sharp cold fronts coming through. And if we get a 15-day cold front like we had last year, into December, into January, that particular cold front, I'm not sure everyone's aware, but there were a few days there where Chicago actually got up to $25. And unfortunately, in the western side of the state, northern border, which actually is not that long of a pipeline, but it had the kind of incident that I worry about for this year. They lost some compressors. And subsequently, they cut flow into Northern Natural, which is actually the pipeline that feeds western Wisconsin. And on December 29th, that market peaked at $150 a decatherm with a daily average of $67.45. So those are the kind of things that we try to protect everyone against. And then this from the EIA just gives you an idea of what EIA is calling for the winter. And if you look at it, they're calling for a colder October, and then a colder November, a fairly normal December, January being a little warmer than last year, and then February being colder, and then a fairly normal March. So that's just the EIA's take on what they think is going to happen. So those are the big three fundamentals. And of course, the last wild card is what's happening with the economy and what's happening in the trade wars. If Trump were to proceed with the next round of tariffs, then the Chinese have made it clear that they're going to put a 25% tariff on U.S. LNG shipments, which will lock U.S. LNG out of the Chinese market. That could have the potential impact of backing up some of those LNG loads and keeping that gas in the country, which could also lean towards supporting the winter. So, we've never had to worry about, as I was talking about exports. I mean, we export about 5 BCF a day to Mexico, and then we also export about 2 BCF into Canada. Of course, they import to us. I mean, there's tremendous energy flows between the NAFTA partners. But now with the U.S. also building up its LNG export capabilities, that's right now. That was 3.3 BCF last month, and you got 2 more liquefaction trains coming. So, that's enough gas to help swing the markets, and we've never had to worry about that before. Now, one of the things we always talk about when we talk about whether to hedge or stand pat is that the program that we have everyone in is a best practices program that is designed to limit gas price volatility. As I mentioned earlier, the transportation cost, the basis cost, has actually been the most volatile component of the natural gas supply chain. In fact, we were just looking at this. One of our clients is expecting greater usage now in January and February, and asked last week if we could secure additional transportation for him. The transportation cost is up 9-fold from the spring. The people in the industry are realizing what we're talking about here today. So they're saying, okay, gas has to come from out of state. Gas has got to come from longer distances. We need to secure those transportation paths. So consequently, between April when we did our RFPs and last week, the basis or transportation cost for Wisconsin is 9 times what it was in the spring. That's why we like to get out there. I mentioned earlier, I'm always shy about locking up gas price because you never know what the markets are going to do. But the basis is something that I will always lock up. Did it for years for my other employers, did it for decades with TVA. You don't let basis get away from you. So by going out and locking the basis is a big factor controlling the volatility of your gas price. Second thing we do is we link the gas price in the contracts to the first of the month NYMEX. And, I think you've heard, maybe a few of you have heard me talk about it before, but if you go back to polar vortex, the gas in Chicago during the polar vortex got up to over $25. The NYMEX that month priced at $5.56. So if you were linked to something that reflected Chicago price, we saw potential clients getting charged as much as $25. Where those that are linked to the first of the month NYMEX, which is much less volatile, were locked in at $5.56. The other thing is when you price it against the NYMEX, you always hold the right to trigger or to exercise a hedge to fix the price. Whether you decide to do it or not, is your choice. And we're always open to have those conversations on why we think you should go one way or the other. But it is always good to have the option to fix the price. Then, another way we help control price volatility is that we I'll insist that all the suppliers price any imbalances against monthly averaging pricing. And I'll take it for instance. If you don't have specific language in your contracts, and some of the big box retailers in the state don't have the language, they can choose to charge you the highest single price of the month. And we saw this again with a certain company during the polar vortex. for one day, Chicago is $25, but they charge clients $25 for every overrun decatherm they took that month. No, you base it on the monthly average, and you bring that volatility way down. Yeah, an extreme event last year, the Northern Natural System, where you had $150 on December 29th. The average for the month ended up being almost $9. But I think you'll agree that $9 is a heck of a lot cheaper than $67. So by insisting on it being monthly average, your existing contracts knock out a lot of volatility. And then finally, you all know, if you can't audit, you shouldn't do it. There's a number of the big retailers in this state that have black box pricing. And when I say that, I say you go actually look at the definitions in the contract, and it'll say things like gold pool. Well, Platts or Argus or Natural Gas Intelligence don't publish anything called gold pool. That's their price based on